Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the share disclaimer. Be aware that neither Market Chameleon, Demetri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows about Market Chameleon, are for informational purposes only concerning Market Chameleon tools and products. With that, good Monday morning, Demetri.
Good morning, Will. How are you?
Great.
Good morning, everyone. Let me share my screen here. And while I'm doing this, if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into that live chat on YouTube. Will's keeping an eye on it. He'll let me know when they come in, read them back to me, and then we'll try to answer as many questions as we can. In the meantime, we're going to take a couple minutes to give you a chance to put those questions in, and we'll review our pre-market report to see what type of insights we could get in the pre-market trading. So up here, pre-market report, you could see we have this calendar view with summary statistics, what happened in the pre-market hours on those specific dates. This allows you to compare today's activity to the most recent history and see if you could just scan and eyeball if there's something unusual. We're going to review today's activity over here, October 21st, and we can see we have so far 516 stocks trading higher in the pre-market, 532 stocks trading lower. We have 290 million shares trading on up volume, 77 million on down volume, and we have $1.5 billion worth of stock trading higher, $3.7 billion worth of stock trading lower. So from that perspective, it looks like we have a somewhat bearish bias in pre-market trading. Let's look at it from a couple more perspectives, and then we'll move on to our questions. I'm going to slide down this page, and now you see we get this more granular view of what's going on in pre-market hours. We have stock symbols with price and price changes and volume. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners. And here I see 106 stocks made it onto our biggest percentage gainers list, 78 on our decliners. So that kind of indicates a more bullish bias in the pre-market trading. Now, to make it onto this list, we have certain trading thresholds because stocks in the pre-market could have very low volume, very low liquidity. And if it meets our minimum trading thresholds that we put in place, it can make it onto this list, and that could include small cap stocks. It could be an ETF. It could even be a leveraged ETF or an inverse ETF that moves in opposite directions of its underlying. So to narrow this list down further, we could use the filters we have above. I'm going to just talk about these first two. The one here in my watch list, that could be an important filter for those of you who only like to track a certain group of stocks that you created in your own unique watch list. So you create the watch list, and then you want to see if that particular watch list, if any of those stocks meet our pre-market conditions. If you use that filter, you could do that. If it meets the conditions, it'll pop up in this list. We're going to use our ETF filter because it's a similar concept, but this comes out of the box. So if you click on it, you get these different ETFs to choose from. These are broad-based ETFs and sector ETFs. We're going to select SPY, the first one. And you could see when we did that, the list below got filtered by stocks that are holdings in the SPY ETF and met our conditions. And here we have 7 stocks that made it onto our biggest percentage gainers list, 8 on our decliners list. So that's a mixed bag there from this perspective. But what we did was narrow down the group of stocks we're analyzing to S&P 500 companies. So we gave it a couple minutes, Will. If we have questions, I'll start taking them now.
Yeah, I don't know. Rob is just, he said Boeing looks like they we'll get the strike settled this week. Big move this morning pre-market. He then goes on to say Boeing reports earnings on Wednesday and the union votes then as well. New strike. Maybe look at the straddle, what the straddle is saying. I think not really a question, but he sent that out to everyone in the group. I don't know if you want to take a look at Boeing's, where it's pricing the straddle relative to previous earnings or something, but that's happening on Wednesday. That was the only thing that came across.
Okay. I mean, if the question's to look at the Boeing straddle, we could do that if you want.
All right, great.
Okay, so but if there's a follow-up question or something different, let me know. But if it's just looking at the straddle price, we'll examine that. And right now,
perfect. Before you do that, can I share my screen?
Sure.
Everyone was wondering actually how Philly went. Did you like it? Did you like
Pittsburgh?
Pittsburgh?
You know what?
Yeah.
I forgot to bring my University of Pittsburgh paraphernalia that I got. I got all these things, and I prepared them in the living room that I forgot to bring them, but I'm gonna do it tomorrow. But it was great. The trip was really nice, and the city is actually really nice. I like the campus. Let me go back. Wait, did you share the disclaimer?
Yeah, I shared it. You can share your screen.
Okay. But yeah, thank you for asking. My daughter, she got accepted to University of Pittsburgh, and this is the first time I traveled with her. She went with my first time just with my wife. We all went together this time, and it was a very impressive campus, and the city was really nice around there, and they have like a really good program. So just all good things to say about it. I didn't even know Pittsburgh has like 500 bridges.
Yeah, it's a city of
I learned
bridges.
about,
Yeah, it's a city of bridges
City
and
of
lots of
bridges.
different neighborhoods and
Yeah, I learned a lot of I guess just uh, extra information about it that I didn't know. So very excited about University of Pittsburgh and yeah, I really liked it. And I think we had some people who live in Pittsburgh I talked to before, gave me some suggestions. I only had, a day to go over the campus. So
yeah, well, it's going to be great
then.
exploring it for the next 5 years, right?
Yeah.
That's going to be exciting.
Yeah, exactly. So,
All right.
thank you for asking. So let's start with Boeing up here.
All right. So to get there, you just typed BA in the search at the top, right?
Yeah, up
And
top.
now you're in.
Yeah, and I think the question was just looking at the options straddle. So I'm going to go to the options chain. And here, there are a couple things here going on. Obviously, Boeing has news that's specific to that company right now. Rob was talking about, and you always have to take that into consideration. So stocks, they're when we're analyzing stocks, right? When you're analyzing stocks, it's important to know that the specifics to that stock, right? And when you learn about it, knowledge is power. When you learn about it, that allows you to formulate a more informed decision, a better financial model, and to take into consideration things that are unique to that stock. You have to consider, and we're not going to go over that because we're not going to go and read every detail of the news. I'll leave that up to you guys and the trader. So there are things going on right now in Boeing that you have to do that research and be aware of because it's unique to that company. And it could be a unique situation that we don't even have a specific history, to reference and analyze. And information could be changing, in real time based on that. But I think the question was, can we take a look at the Boeing straddle? And maybe it was for the earnings. So earnings are coming up October 23rd before the market opens. So that's the indication we have, based on press releases. So that's where we're expecting it. And given that, that means that the October 25th expiration over here will cover the earnings. Okay. So I'm just going to click on that over here. And if we're going to actually look at the earnings straddle from the perspective of an earnings straddle, let's take a look at the historical straddles, right? So that's what we should do before we even come here. Let's just get an idea historically. Well, on average, what was the implied move for a straddle right before earnings? So let's just say that if the earnings are going to be released before the market opens on October 23rd, where do we think the straddle at the end of the day, October 22nd, is going to be priced around? So we could see, like, where it closed at 155. So we could bring up the, 155 straddle. We could see where so the straddle is buying a call, right, and buying a put. So what I did was I clicked on the call, the 155 call. I clicked on the ask price. So that brought up buy October 155 call for price of 465. So we could change these, but it will populate. I will click on, and then I clicked on the 155 put 415. So you could see here, October 25th, the 155 put for $4.15. Could change that, but it populates the price that we clicked on. So if we run the analysis at this point, here's what we see, that if you did that at $4.65 and $4.15, then if you bought both of them, you're paying $8.80, right? So that's what the net debit is. Well, given that $8.08, what do we think on average at this stage is a fair value or theoretical value of the straddle? So obviously we don't know what's going to happen. Like, there's no way of us knowing what the earnings release is, and there's no way of knowing what all these different traders are going to do, right? Because once the earnings are released, well, you're going to have different opinions of how to interpret that earnings, and you're going to have institutions, you're going to have retail traders, you're going to have professional traders, all of them coming in there, and they're going to, trade based on their own unique interpretations and forecasts and understanding of those earnings. So we have no idea what the stock is going to do on October 23rd before after the market opens or at the end of the day. We have no idea. But since we don't know it, we could look back in history of similar situations when there was unknowns, right? So if there's unknowns, but we do know that earnings are released once a quarter, we could get a sense of, well, how did the stock move historically, and how was the option straddle priced historically right before? Are we in range? Are we in, it's kind of like, we don't know we don't know a football game, let's say, NFL is playing, so I like to watch it, but we don't know what the score of, of the football game will be, or if we combine the scores, we have no idea. It could be 7 points, it could be 60 points, but we could look at history to get ranges and averages. So this is what we're doing. So we're going to take a look at, on average, what would this straddle be priced theoretically if we just looked at the historical stock moves given similar situations? That this, if we looked at the same amount of days to expiration with the same days to earnings, covering earnings, all this, if we gave him the same kind of historical conditions, what would this straddle be worth on average based on the stock move? So that's this one, historical stock return distribution. And here we see that on average, the straddle would be worth $7.73, just based on how the stock moved historically. And if we compare that to today's price, it's $8.80. So you can see if you're buying it for $8.80 and on average it's $7.73. Well, what's the difference? What's the difference between the net debit you're paying to the average? Well, it's $1.07. So you're paying $1.07 in theory more than that average, if that's what we used as our benchmark, our theoretical value. But keep in mind that there's other things going on here, right? That it might be justified. You know, Rob brought it up. You got stuff going on with you know, that they're trying to resolve with unions, with the so there's other stuff going on which could give it an extra volatility, right? There could be more volatility, more uncertainty, you know, less liquidity than those historical observations. You have to take that into consideration because this, you know, the model could only look at the numbers. It still relies on you to start looking at all those pieces to put together. Okay. So yes, this looks that from the historical perspective of how the stock moves, the straddle is priced about $1.07 above that average. So that's the average, but does that mean it never went above 880? That doesn't mean that, right? It doesn't mean it can't go above 880. It's just looking at the average. So we want to know, well, given the history that we're looking at, I think this is like a 4-year history, maybe. That I actually set the defaults 4 years. You could reset that. But given the history, how often did it go above 880? You know, just because the average is 773 doesn't mean every time that's how the stock moves. Sometimes it can move a lot, sometimes a little bit. How often did it move by enough that even 880 would have, if we paid 8, you know, from a historical perspective, it moved by a big enough percentage to cover. Well, that happened 31% of the time. So about, you know, you're close to a third of the time, the stock actually did move by a big enough percentage that even this 880, you know, would have resulted in a profit if you're talking about, you know, straddles. So that's also important information. It's not like historically, it's not even out of the realm. You're talking about 31% of the time, stock moved enough, right? That even given today's more uncertainty, you know, that's not that unusual. So let's look at it in another perspective. This is saying by 31% of the time it was a winner if we just looked at the observations from start date to end date. That's it. Like, so whatever you have here, you're talking about a 5 trading days, 7 calendar days. So 5 trading days. So if we, you know, from start date, you wait 5 days to expiration, how much did it move? That's what this is looking at. Right? That covers earnings, right? It has to cover earnings just like this. But the stock itself, the underlying, it doesn't trade that way. There's trading in between, right? If you have 5 days, you're going to have trading, you know, day 4, day 3, day 2, all the way to day 1 with volatility, which means that it could move around within those days. It has 5 days to move around it could have like a lot of volatility where it doesn't necessarily, if you from 5 days, it doesn't necessarily finish all the way on its high or on its low, right? It could move around and then it could even finish unchanged, but it could have had enough movement that at some point it would have covered this straddle. It could have been the next day, it was up 20%, then it came back to unchanged. So what if we just looked at it from the perspective of at any point in our observations, at any point, we have 5 days, at any point within, 4 days to go, 3 days to go, and the intraday volatility, because it doesn't trade just once a day, there's continuous trading, right? From 9:30 to 4, you have continuous trading. So at any point did it move enough to cover the cost of that straddle? It has to move by a big enough percentage. So that's what this is, probability of touch at any point. That's 56%. Obviously, that would be higher, right, than 30, because we know at least 31%. But what about at any point? Well, that's 56%. That's telling you, okay, even though, that average is low, it's saying that, look, historically, more than half the time, at some point, that straddle, that movement in the stock would have covered that premium. The movement in the stock percentage-wise would have covered that premium 56% of the time. So, now we're getting some information here. Now it's up to you to, do you think it's going to be illiquid enough to actually, even cover, if you're buying it, is it going to be liquid enough? Is there enough uncertainty out there or the news that it could actually, move at a higher magnitude than the historical observations we're looking at? So that's based on the stock move. But what about the straddle itself, the premium, right? That's looking at the stock moves, but maybe the premiums, just the options alone, right, just tend to be priced a little bit higher than the historicals or a little bit lower, right on. Just because that's based on the actual stock outcomes, the options themselves could have been priced differently on average. So think of it like, if you're looking at a football game and, prior to the game, you have these odds, like over under. And then after the game, you have the actual results. But those two are going to be different. How things were priced prior to the event and the outcome of the event. So how were the straddles priced prior to the event, prior to the expiration at this stage? So if we looked at similar situations and said, okay, forget about what the stock did. What if we just looked at the options chain like this and said, well, how are the options priced? All right, so we're going to take the options based on their applied vols and take the average in similar conditions and then work our way backwards and say, okay, based on the options pricing model, on average, what would the options be priced? So here it's saying on average, $8.37. Okay, so that's a little bit closer, right? Now we're talking about 43 cents away. It's a little bit closer, but that's the average. So the average obviously could get pulled down because you had some maybe low ones, or could get pulled up because he had some high outliers. So what about the median return? What about if we took all our observations and said half of them were priced below this amount, half of them were priced above this amount? Well, that's 863. So now we're getting closer to that 880, right? 863. Now we're getting closer to that historic. What if we just wanted to know the entire range? Give me the low and the high. All right, now I have the average, I have the median, What was the low and high end? And that's what this is. As low as 745, as high as 886. So we can see it's priced near the high end at 880. But it's within it's still within the range. It didn't, go above that high yet or below it. And we got this new, potential information that could make it move. And if we slide down here, we also see that 880, if we look at the bid of the straddle, 850, and we look at the ask, 880, obviously we're 880 is on the high end of the market. That's if you pay the offer of the call and the put. But if we look at the spread, it's from 850 to 880 with the midpoint in between of 865. So given that 865 midpoint, right, 865 midpoint, that's kind of in the historical range of 863, right in the median. Right. So really the markets right now look like they're pricing the options in line. If we looked at the median price, in line with their historical range, right? That's where historically they've been priced around 860, 863. And it's within its historical high low, so with all that, you're getting that information where, it's probably within its historical range of where it's tended to price, but maybe a little bit higher towards the higher side than the lower side. Right. So that's where it is. Look, within its historical range, a little bit closer to the higher side than the lower. That's what the markets look like in this particular straddle. So, well, I gave it I think we're almost at the end, so I'm going to stop here. If you don't have any other follow-up questions.
Yeah, nothing. Let me just confirm it runs on a little bit of a delay. No follow-up. Rob says, thanks. That was great information, D. As always, great job. Thanks for everything. Glad you enjoyed your trip to Pittsburgh. Looking forward to hearing reviews of restaurants, places to see. You're going to be going there for four years. Actually, I guess, yeah, she's a senior the next year will be her freshman year. So
next year would be her freshman year, yeah.
4 years of traveling to Pittsburgh. Should be fun. Yeah. Awesome job, buddy. Thank you so much.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trading peace.